So the banking system is supposed to begin collapsing tomorrow on March 11th, at least according to influencers like my new best friend, Cancel This. Because tomorrow is when the bank term funding program ends. A bunch of emergency loans given to banks after the bank runs in 2023. Right now, the big community bank that a lot of investors have their eye on is New York City Community Bank. Their quarterly reports have been looking worse and worse because they are so heavily invested in commercial real estate, which is struggling, especially in the office sector. Stock price has been tanking. A former treasury of the secretary just put $1 billion into it. But why? Maybe a former treasury secretary and somebody with access to billions of dollars knows something that we don't. And would you look at that? The buyout is actually happening tomorrow on the 11th when the BFTP ends. Maybe, just maybe, he knows that we are not due for a banking collapse. The FDIC just released their most recent list of problem banks. The number of those banks did increase from 44 to 52, but the total asset value of those problem banks is $66 billion. And New York Community Bank was not on that list. Either the FDIC is completely incompetent, or New York Community Bank is fundamentally stronger than most people think. Grant Cardone, the real estate magnate, says we are witnessing the greatest real estate correction in my lifetime. In that same article, he says it's going to be a great opportunity for individuals, regular, everyday people, to actually grab trophy real estate from institutions. What about Jeff Bezos and all these other billionaires selling their stock? He's already sold 50 million shares of his Amazon stock, which still leaves him with 938 million shares. He and all these other billionaires have sold a small percentage of their holdings, maybe for tax reasons, maybe they want to start buying other assets that are going to be declining on the cheap. We don't know. This man, Trade Invest Simplify, can tell you a lot more about this than I could in greater detail. Give him a follow and listen to what he has to say. But hasn't the Fed overprinted trillions of dollars? Yes, but let's take a look at the money supply. See how it's done nothing but unreasonably grow since 2010? For the first time in over a few decades, the supply shrunk and is staying flat. That's a good sign. But didn't the Fed say something ominous and creepy the other day? They sure did. Fed Chairman Powell said the pandemic is still writing the story of our economy right now, and we should just be prepared to be surprised with the next chapter. But if you just read the next sentence, that was the case in 2023, when the U.S. economy delivered very strong growth and robust labor market while inflation declined sharply, a situation very few forecasters correctly anticipated. And sure, people are feeling the economic pain of this. We are not seeing loan delinquencies or defaults on mortgages skyrocket. Right now, it's not even at 1.5%. It's at 1.38. Let's compare that to the Great Recession or even the recession of the 1980s. While job quit rates are still falling, they are still much higher than pre-pandemic levels. A lot of you are probably too young to remember what the 2008 recession was like. It was much harder and deeper than this. And domestic deposits in the banks have actually increased for the first time in a year and a half, or 7 quarters. Despite all the bad news about community banks, they actually reported a 1.8% increase in their loan balances. And that scary number, $722 billion in total unrealized losses held by all the commercial institutions, has dropped down to $477 billion. Because the market balances out. Yeah, that's still a high number, but it is a $250 billion drop in losses. Those bond yields keep dropping on trend like analysts are expecting, then yeah, you're going to see the unrealized losses vanish even further. All right, but what about the derivatives market? Isn't that going to kill us? Maybe. But what kind of derivatives? There are several. Derivatives are just financial instruments based on an underlying asset. It could be options, swaps, futures, you name it. They could be based off of any commodity you name: cotton, oil, pork bellies, whatever. But you can also have credit, foreign exchange, and interest rate derivatives. Interest rate derivatives are what we should all be looking at. Mainly interest rate swaps. Out of the $700 trillion to $1 quadrillion in derivatives contracts, interest rate swaps account for most of it, about $500 trillion. And its name is its definition. Literally, two parties get together, they sign a contract saying, okay, we are going to switch each party's interest rates to one another. It sounds very boring, but you get to do it with anything that has an interest rate, like bonds, mortgages. Why is there so much money in this? Because interest rates, especially bond yields like the 10-year and the 2-year, are high. Unless we start to see loan delinquencies skyrocket, if interest rates start rising at the level that they did 18 months ago, or even if interest rates plummeted too quickly, that would start to scare me. Just like I said in my previous post a few weeks ago, there's not enough evidence suggesting that a banking collapse is imminent. I am the Geo Hussar, and I just took a $100 gamble on NYCB this Friday. And that was even before I saw this announcement. For everyone who is 100% certain that this bank will collapse or the entire banking system will collapse, please show me your short positions. Show me how you have bet with 100% assurance against the economy.